Okay, so what really jumped out at me first, looking at the data we have today, is a pretty surprising statistic. Nearly half of South Africa's business owners, especially the micro, small, medium enterprises, the MSMEs,
Yeah.
they aren't actually going to traditional banks for credit. They're turning to non-bank lenders instead. We're talking 48%. That's huge, isn't it?
It absolutely is. It really shines a light on a crucial part of South Africa's financial system that maybe doesn't get enough attention. And what's maybe even more telling is even if you look just at the formally registered MSMEs, 41% of them rely on these non-bank providers, these NBFIs.
41%. Wow.
Yeah, which is nearly as many as the 51% that banks serve. So you see, NBFIs aren't some like fringe activity, they're fundamental.
Right. Okay, so let's unpack this. Today, our deep dive is all about that exact role, the vital but maybe overlooked role these non-bank financial service providers play in South Africa's whole push towards financial inclusion. Our mission here is to look at some new data, some fresh insights that came out of a recent global meeting, and really try to get our heads around the challenges these boots-on-the-ground lenders are facing. What's getting in their way, and what do they actually need to, stay afloat and keep having an impact?
And the insights we're discussing, they come straight from new data presented just recently at the International Committee on Credit Reporting, that's the ICCR, at their spring plenary for 2025. It was actually held in Cape Town.
Yeah.
We've also got some really important commentary from Microfinance South Africa, or MFSA. And just quickly, for context, the ICCR is a global body set up under the World Bank back in 2009. They're basically the recognized international standard setter for credit reporting. Their whole focus is developing standards to boost financial inclusion and stability globally. So they're right at the heart of this conversation.
Got it. So that 48% figure, nearly half of all business owners using NBFIs, it's definitely striking. But what does it really tell us about where the action is, for South African businesses, particularly the smaller ones?
Well, what it tells us is NBFIs aren't just like plugging a small hole. They're essentially the main doorway to credit for a really big chunk of the economy. The data shows pretty clearly that most informal and micro business owners, they often feel like they're, quote, forced to borrow in their personal capacity.
Uh, right. So not as a business, but as an individual.
Exactly. Because the hurdles to getting affordable formal business credit from the usual places are just too high, often insurmountable. Just imagine that. You run a business, you need funds for the business, but the system pushes you to take a personal loan. And that's precisely where NBFIs step up. We're talking microloan providers, community finance groups, even some of the newer fintech lenders. They fill that gap.
Which brings us to Leonie Van Pletsen. She's the CEO of Microfinance South Africa, MFSA. And she had this great phrase describing non-bank lenders as the boots on the ground in advancing South Africa's financial inclusion journey. What does she mean by that, you think? Boots on the ground?
I think she's highlighting their directness, their presence right there in the communities. They're willing to work with people and businesses that, frankly, traditional banks often see as too risky or maybe too small to bother with or too informal. She really emphasizes that these lenders, quote, assist business owners and underserved consumers where others will not. They're literally operating right at the edge, where the formal financial world kind of stops and the informal or emerging economy starts. They provide that absolutely crucial link.
Okay, so they're doing this incredibly important work, filling a huge critical need, but it can't be easy for them. What are the big hurdles they're actually facing? It sounds like there's this sort of dual challenge making it really tough for the ethical lenders to keep going.
That's exactly right. The discussions at the plenary really focused on two major systemic issues that sound almost, well, existential for these lenders. First off, limited access to good quality data.
Ah, data access. Okay.
Yeah. I mean, try assessing loan risk when you've only got half the information right. This lack of comprehensive data, it really hampers their ability to do accurate credit checks. And the direct result, they often have to price loans higher to cover that unknown risk. They can't measure the risk precisely, so they have to build in a buffer.
Okay, that makes sense.
Uh-huh.
And the second challenge, you said it hits their bottom line?
Exactly. It's this nasty combination of high operational costs because serving smaller, often more hands-on clients can just be more expensive, per loan.
Right, more labor intensive maybe.
Precisely. That combined with prescribed caps on the interest rates they can charge and fee structures that are static that don't really adjust. So their costs might be rising, but their potential income is sort of fixed. They're caught in a squeeze.
Yeah, that sounds like, well, like a recipe for trouble, especially if you're trying to run an ethical business.
It's a major squeeze, absolutely. And this point is so critical that Leonie Van Pletzen made this really urgent call. She said, the national review of rates and fees that is currently underway is no longer just a necessity, it is urgent. It's basically a plea for immediate attention.
And she was pretty blunt about the consequences, too, wasn't she? She gave a stark warning. If we do not get the pricing right, we run the high risk of driving ethical lenders out of the market.
Extremely stark. And think about the knock-on effect of that. Her warning finished by saying, the detrimental impact of this is that vulnerable consumers will be pushed back into the hands of illegal and often predatory lenders.
Wow. So if the legitimate options disappear,
Then the only choice left for people who desperately need that credit might be the loan sharks, the unregulated exploitative players, which is exactly what everyone wants to avoid. That's why getting the whole regulatory environment right is just so, so crucial.
which leads us perfectly into the call for balanced regulation that came out of the ICCR meeting. Clearly, something needs to shift to support these lenders, not accidentally push them towards the exit. What were the main things highlighted there? What kind of environment do they need?
Well, the discussion really landed on three key needs. First, South Africa needs a national framework specifically for NBFIs, one that actually encourages innovation and sustainability and responsible lending, not just one that restricts everything.
Yeah, a supportive framework.
Second, there was a strong call for proportional regulation. Regulation that understands and fits the reality of these smaller, more inclusive lenders. They aren't giant banks, so you can't just apply the exact same rules and expect it to work.
That makes sense. Tailored rules.
Exactly. And third, they need fair, risk-based pricing models. Models that allow them to price according to the actual risk, ensuring that the sheer cost of complying with regulations doesn't become this impossible barrier either for the lender trying to operate or for the consumer trying to access the credit. It's finding that sweet spot, really.
So MFSA, Microfinance South Africa, they're really pushing for this kind of nuanced approach then. They're saying, look, protect consumers, absolutely, but don't make it impossible for ethical lenders to actually exist. Is that a fair summary?
That's precisely it. They absolutely support, quote, robust consumer protection standards. I mean, that's non-negotiable. But they emphasize these standards have to be matched with policy tools that enable legitimate, regulated lenders to remain sustainable in the local market. It's all about finding that balance, that delicate equilibrium between protecting vulnerable people and allowing the organizations that serve them to actually survive and thrive. So yeah, the big message coming out of that ICCR plenary was pretty clear. These non-bank lenders are doing vital work on the ground. The system, the regulations need to evolve to work with them, not unintentionally work against them.
Okay, so let's quickly recap our deep dive today. Non-bank lenders, these NBFIs, they're playing this absolutely critical boots on the ground role in South Africa's financial inclusion efforts. They're reaching almost half of all business owners, a huge chunk of even formal small businesses, often where traditional banks don't reach. But they're walking this very real regulatory tightrope. They're fighting against limited access to the data they need to make good decisions, and they're squeezed by pricing models that might just be unsustainable, threatening their ability to operate ethically. The clear signal from the ICCR meeting is these guys are essential, and the rules need to help them, not hinder them.
Exactly. And maybe stepping back even further, this whole exploration of microfinance and non-bank lending in South Africa, it really raises a bigger question, doesn't it? A universal one for you to think about. How do societies anywhere in the world truly strike that balance? The balance between the critical need for financial access for everyone, especially underserved communities, and the absolute necessity of making sure the lenders providing that access can actually operate ethically and sustainably. What does it really take, for a financial system to be genuinely inclusive and robust, to serve every entrepreneur, every family, not just the ones who already fit neatly into the existing boxes? Something to ponder.